We're going to call the meeting to order, the Town of West Warwick Pension Board meeting. The day today is Monday, March 7th. We're in Town Council chambers at 6 p.m. First order of business is going to be the prayer. Dear God, please grant this board some guidance and helping to make wise decisions for all the beneficiaries of this plan. Please watch over our police, fire, and military personnel. And Lou, can you lead us with the pledge, please?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Moving on to roll call.
David Lemoy.
Here.
Donna Lucia. Here. Louis Fasano.
Here.
Jeffrey Coslin.
Here.
Approval of minutes. Minutes from January 11th, 2016 and February 11th, 2016. I'll make a motion to approve.
A second.
Motion's made and seconded. All in favor?
Aye.
Aye. We'll skip over executive session. Board council report. Do you have anything for now, or do you want us to?
No, I think everything should be on the agenda, or it's already listed in the executive session, so.
Very good. Moving on to payment of bills. We have Olin and Penza, file number MBF 7372, West Warwick Pension Board General File. The amount is $5,466.10. That's for December 2015. And we also have $4,338.00. That's for January 2016. I'm just going to list them all. We'll vote on them all. File number MBF 7372-22. Amount is $1,091.50. That's from December. And also 767.50. That's from January. File number MBF 7372-25, that's the plan redraft, $1,152.00. File number MBF 7372-31, West Warwick Pension Board Custodial RFP, that's $90, and I'm going to guess 0 cents here. Is there a motion?
I make a motion to approve the bills for Olin and Penza.
Motion's been made. Is there a second?
I had a question on a couple that were in the packet.
If you want to just second it, we'll have discussion. Just second the motion, we'll discuss.
Okay. Second.
Motion's made, seconded, discussion. Go ahead, Donna.
I have a question where we still have, actually have a credit balance on MBF 7372-20.
Dash 20.
It's the original.
Yeah.
It's not under H?
There we go.
No, I don't see it. Is that paid? Do you know why it's in the
No,
packet?
it's a credit balance, so
Oh,
it's
okay.
actually, it's an overpayment.
It's an
I see.
overpayment.
Oh,
There's
584.
also another
And there's
overpayment
another
from
one.
Duffy.
Correct.
Okay, that's
So it
good.
looks like those were paid twice, so I had my billing person leave them on there because there were overpayments on those two files just to have the board vote on what you wanted me to do. I can have her cut a check back, or I could have her credit those amounts to one, like the general file or one of the other accounts. It's completely up to the board.
Yeah, I think it should be credited towards maybe the plan.
It's easy enough, I mean.
I agree.
So credit it to the /25, or credit it to the general file, the 7372.
General file, what is, yeah.
Okay.
Thank you.
All right, so motion's been made and seconded to approve. All in favor?
Aye.
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 I oppose, 3-1. H2 is Nyhart. We have actuarial and administrative services for ongoing administration. The amount is $8,190.00, For some reason, there's two amounts here. I don't know if it's different months. I don't know which month is which. All right, but we also have $8,575.00. There's a death benefit calculation in December, $2,025.00. Actuarial Administrative Services, January 2016, $1,250.00. Actuarial Administrative Service, August 2015, 3-year pension expense analysis, $735.00. Actuarial and Administrative Service, November 2015, $625.00, and fee for professional services in December of 2015, $39.15.00. It seems like the bills are almost the same thing. I don't know if it's just a breakdown. Is that what that is? Because it says actual administrative services.
No, there's 2 invoices in there.
All right.
For those different amounts. You have it right here. The first one, $81.90, and the next one is July, $8,575.
Yep.
Yeah, the whole annual valuation was but they're just both listed under
I
that.
see.
There's 2 different bills because
All right.
everything came in because of not having a meeting last month.
Yep. That makes sense.
Doubled up on everything.
Okay. That makes some sense. All right. I'll make a motion to approve H2, and the amount is stated.
Second the motion.
Motion's made and seconded. All in favor? Aye. 4-0. And H3, Town of West Warwick Finance Department. Clerk expenses for July 1, 2015 to September 30th, 2015. The amount is $1,660.33. And also 10/1/2015 to 12/31/2015, $984.88. That's basically the second half of the year. I'll make a motion to approve, and the amount is stated.
Second the motion.
Motion's made and seconded. All in favor? Aye. Applications received, Raymond Beatty, tax assessor, normal retirement, effective 6/1/2016, I'm sorry. I'll make a motion to receive the application.
Second the motion to receive.
Motion's made and seconded, all in favor?
Aye.
And now we have item J, Nyhart presentation, actuarial valuation report. Take it away, gentlemen.
Yeah, I told Carol to get here around 6:30.
That's fine.
Good?
Yep, whenever you're ready.
All right. So what we've got here, I think there was copies of it out front for everybody too, is it's not the official valuation report itself. This is a summary of it. This is a management summary. The actual report itself, I believe is going to be out on the town website or something. But honestly, it puts you to sleep if you want to look at it. It's there. All the numbers are there, but everything is in here that is of importance.
Okay.
Start on page 3, I guess, and just talking about changes that happened for 2015. When I say 2015, we do a valuation every year as of July 1 for you guys. And so this is a summary of the July 1, 2015 valuation report we did. Changes that happened, there's really 2 changes. Back in the spring, in March, we delivered you guys an experience study, which is it's a study looking at, do people die, quit, retire, pay changes the way we think, become disabled, do all those things the way we've been assuming it historically. And this is part of the state requirement that you do one of these studies every 3 years, which is, it's very, that isn't just a state of Rhode Island thing, to be honest with you. That's very common across the country for these governmental plans, is to do these studies to make sure that the assumptions we do make sense and it's actually how your people are behaving. So we did that back in March, and the one change that came out of that, or adjustment we had to make, was for the mortality table. So when do we think people are going to die, or how long do we think they're going to live? There's lots of gory details about it, but essentially what happened is this. We moved you from a table that was based on a 1995-ish study to something that's based on a 2006 study. So it's about a 10-year newer table. As you would guess, during that time, mortality improved a little bit. People are living a little bit longer now than what they were. So when we implemented this whole new table, essentially the impact it had on you guys was to say, we think your liability and your costs basically are about 2% higher than what it was under the old table. So not a huge change, but it was It was an increase in the cost of the plan. That was one thing. The other stuff, to be honest with you, there wasn't enough of a change or enough difference in any of the things that we came back with where we said we should change our assumptions at all. We felt comfortable leaving them where they were. The other change we did make, though, is it ties a little bit around the timing of the contribution that we calculate. And without getting in, again, happy to answer any of the details you want, but essentially what we're doing now is when we did the valuation at July 1, 2015, we are going to project it forward in a way that for budgeting purposes, it'll be a number and a contribution that you guys can make then for the 2016-17 fiscal year. So we get that number done, calculated in, say, November of 2015-ish, roughly, and now the town will be able to use that to say, as they prepare the budget for fiscal 16-17. Because before, what was happening is you'd get into your fiscal year already, and they wouldn't have the number to be able to budget exactly what we thought it was going to be before. And so there was always, it was just difficult to tie what we recommended as a contribution, what actually went into the budget, to the dollar amount. And now we'll be able to do that a lot easier. And from our perspective, there's no reduction to security of the benefits or any issues with the funding of the plan or the amounts going in or anything else with this changing time. The timing is just making it a little easier from a budgeting standpoint. So those are the two changes really that happened for 2015.
And just with, to regards to the mortality tables, you actually looked at a snapshot of our population?
Yes.
For those numbers?
Yeah,
That
so.
indicated that we needed to increase?
Yeah, and to be fair though, you know, the population size that we're dealing with here for you
Right.
guys makes it really tough for us to get a lot of credible data out of it. So we really bumped it up to say, like public safety, we're going to stick with the blue color table still. We don't think we need to move to a white color table or anything like that. And I'm treading on how deep I want to get into details here, but there are different tables that say how long do we think people are going to live, and then there's another factor that we use on there that says how long and how much do we think it's going to keep improving in the future.
Okay.
So, and there are actually more conservative tables than what we used, but we thought it was too conservative. We thought it was going to make liabilities too high for you guys. So what we used is something the Social Security Administration uses in that regard as well, which turns out now bigger studies are showing, yeah, we probably, there were too conservative and they think the Social Security one is the best. So bottom line is, yes, we did look at your data.
Yep.
It's hard to draw a lot of real credible evidence from that, but from a professional standpoint, I think we have to move to that 10-year newer table to truly reflect the better mortality. Anything else on those?
No.
Okay. Flipping to the next page then, just a summary of what's the population look like year over year. You can see the black section on there are the active employees, the people who are still working currently in any role. It doesn't split up by department necessarily, but any active role. The red is what we call deferred vesteds. And those are people that aren't actively working, but also aren't receiving a benefit yet either. So they're owed something at some point in the future, just not yet. And then the top two bars are people that are actually receiving benefits. So the biggest one there is the retirees, but there's a chunk on top there for the folks who are disabled as well too. And you can see some of the summaries down at the bottom as far as average age and service and compensation, everything like that. It's been fairly steady, you know, an uptick in compensation for this last year, but you know, as far as number counts go and everything else, it's a fairly steady trend. There's nothing that jumps out at us and says, wow, there's big issues here, big changes going on. So, next page just breaks it down by number count, by division. So this is the active groups only, and so we just split. I'm sorry, it isn't the active groups only. It is breaking each of the pieces down, saying what do each of these groups look like by division. What we'll notice a little bit later in the report is we break it down by liability as well, and it doesn't necessarily tie to this number count layout because there are different benefits for different groups and things like that. So this is purely a head count split. Page 6. So really this is, page 6 is the biggest driver of cost. I mean, we will come into you every year and I said we do an evaluation, we've changed our assumptions, all that kind of stuff. all those things adjust what we recommend as a contribution for the year, but it ultimately doesn't change at all what the cost of your plan is. I know it looks like it changes the cost because we're telling you what the contribution is to put in, but ultimately the cost of the plan is what are the benefits that you're paying out to your beneficiaries, be it retirees, disabled, whatever. This shows what that payment stream has been over the past, 6 years, I guess. So 2014, 2015, you paid out about $9.2 million. You can see that number's actually leveled off over the last couple years, and that is almost entirely due to the COLA freeze and some of the changes that were implemented in there to help reduce some of the overall cost of the plan. So you can see the impact that that's actually having here. Next slide just shows what's the asset performance measured sort of simply by us. We're not going to match exactly to what your asset managers do, and we don't get as sophisticated as they are on their returns. But from our standpoint, what's the asset return look like? You can see the ins and outs of the plan here. So started last year around $28 million, paid out $9 million, had contributions coming in of about $8 million. From the employee contributions of about $1.7 million, some expenses, investment return, gets us to around a market value of about $29 million. The difference on these two numbers here, the market value and this plan assets that we call it, is market value is exactly what you think. It's what you're going to go find on your trust statement. It says, here's how much money we've got invested. The plan assets is what we actually use when we determine your contributions. And what it does is it builds in a little bit of smoothing as far as investment gains and losses. We don't want your contribution that goes into the town to be bouncing all over the place with the market. We want to make that a little bit of a steady stream. So we'll take good years and bad years and sort of smash them together and offset each other to try and keep that a much steadier stream in there. So that's the difference in those two. I will say, that investment return on a market value basis was only about $638,000. Ultimately, what that turns into is the fund was about $1.7 million less than we would have projected it to be the year before. That doesn't mean that your contribution goes up by $1.7 million immediately, but what it does mean is sometime over the next 10 years or so, that money is going to have to get made up in either improved returns, better than we expect going forward, or additional contributions. One of those two places is going to have to make that money up.
That's a 5-year smoothing as far as I remember?
That's exactly right. Yep, we smooth those things in over 5 years.
Okay.
Yep. All right. Page 8 just gets into what are those returns been that we've calculated over the time. Over the past 7 plan years, the average investment return on a market value basis has been about 4.6. This is in line with what we've seen with others, but it's obviously not the 7.5 that we assume is going to happen. So that creates that gap that you've got to make up extra contributions over time. Now, again, we can sort of make that 7-year average whatever we want it to, depending on what 7 years we look at. This just happens to be in those 7 recent years. So this is a very common picture for pension plans across the country right now.
Okay.
Page 9, honestly, it's more of an informative page than anything. When we get the trust statements we look at, and this doesn't necessarily drive our valuation or liabilities or anything else, we just get the trust statements and say, okay, based on what we see, here's what your asset allocation looks like. And we want to give it a smell test, basically, to say, does that 7.5% assumption that we're using, does it make sense with the way that your assets are allocated? And there's nothing on here that we look at and say, hey, this is way off base. In fact, we'll get into it a little bit later, but one of the things that we have to do is work with the asset advisors now for them to tell us, hey, here's what we expect each of these asset classes are going to earn going forward, and we got to make sure that then we can justify our assumptions based on their professional expectations of what assets are going to earn. So it does get both a reasonableness check and then them giving their professional opinion on what it should be. So,
have you been in touch with Clearbrook yet at all? Or
we've not talked with Clearbrook yet. We worked with the previous ones,
Right.
but we haven't had to do this yet since the new has come in place. So, So we take all those inputs and now put it together and say, where were we at as of July 1, 2015? Again, the dark red bar on there is that market value of assets. The lighter red bar is that smooth value or plan value. And then the black bar is the plan's liability. So had about $152 million in accrued liability as of July 1, 2015. And like we talked about, assets being around the $30 million mark, which led to a funded percentage in the 19s, 19.8, 19.1, depending on which one of those two you want to look at. Doesn't sound great, and obviously it isn't great, but it's going to be heading the right direction now. I mean, the money's coming in, things are going to start going in that right direction. It's just going to take time to get there. As we saw earlier, the plan's paying out a little over $9 million in benefits, and you had $8 million come in as contributions, so you're not going to see large changes in this happen on a one-year basis. It's really, the plan is designed to get it fully funded over about a 25-year period starting a couple years ago. So we're just getting going in this thing. So earlier we talked about breakdown of headcount by division. Page 11 now gets into what's that liability look like by divisions here. And we don't break it into retirees and actives and all that kind of stuff necessarily, but this is just purely based on those divisions. What do the liability breakdowns look like? And you can see it's the percentage across time stays relatively constant. Each group makes up about the same percentage of the total in time. So. Page 12, then, we put this in here only to suggest the nature and the makeup of the plan. So we talked earlier, if you look at the head counts, if I remember right, the actives and the retirees and things aren't terribly off from each other as far as pure number count wise. But what this chart shows is really the active population in your plan only makes up about a quarter, a little over a quarter of the liability. And so 3/4 of the liability of the plan is made up of people that aren't actively working here anymore. It's not necessarily a bad thing. It makes it so the dynamics and the leverage in your plan is different. What we would typically look at in a plan like that, typically when we're funding a plan, what you want to say is you've got $1 for every inactive liability that sits in the plan. So you would have whatever that adds up to, $110 million of liability covered with assets sitting in the trust in an ideal world. Now, we're not there, but that's the hole that we've got to fill. And when we talk about what your contribution is, it really comes back to a lot of this. The benefits that people are earning aren't going to make up a big piece of what your overall contribution is, because we've got 3/4 of the liability that we've got to get funded and caught back up on. So. All right. So when we talk about the cost of those benefits being earned, that's what this next page is. We call it normal cost percentage, real fancy actuarial jargon. But essentially, what that amounts to is what's the cost as a percentage of pay for the benefits that people are earning on average during the year. And I say on average because these numbers aren't necessarily for any given person at all. It's when we take the whole group together and compare it to your overall payroll. So if I look at 2015, that total NC percentage down there at the bottom, it says 16, just over 16%. What that suggests to you is the cost of the benefits that people are earning this year is a value of about 16% of their overall pay. If you split it up above, you can look and then see, okay, who's paying what piece of that? Based on the employee contribution rates that are coming in and everything, the employees cover about a little over 11%, and the town is paying just shy of 4.75%. That adds up then in total to say that benefit is worth about 16% of pay for a year. And you can see how it's changed over time, specifically going from 13 to 14 when a lot of the changes were implemented to the plan. Okay, so get to page 14 now and say, what's our recommended contribution? And this is where, historically, a lot of the talk has always been, has the ARC been contributed and everything else? Actually, the ARC doesn't exist anymore because the accounting rules have all changed and been adjusted. This is what's replacing the ARC. So this is the actuary's recommended contribution now. And you can look and see the pieces that make it up. There's an interest payment just based on the timing of when the contribution goes in compared to when we do our calculation. There's that normal cost piece, that's the employer piece only. So what we're looking at here is employer contribution only. This doesn't include any employee money specifically. That's already accounted for elsewhere, which is about 4.8%. And then that amortization, which is paying off that 3/4 of the liability that we don't have money out there for, makes up almost the whole cost. If you look specifically in that 2016-17 year, which is the one we just calculated, we're saying we want a total contribution to be about just shy of 57% of pay. Well, 50 of that is made up of paying off that old unfunded liability. So that is obviously by and large the biggest chunk of it. So we're recommending then a contribution for that 16-17 fiscal year of a little over $8.7 million. So we're projecting your payroll to be about $15.5 million, and that getting 57% of that is going to be about $8.7, $8.8 million. So that should be budgeted and be able to be paid then for that next fiscal year, barring the town's performance. Page 15 then just takes that overall number and breaks it down a little bit by division. I will caveat this a little bit with saying this isn't an exact science, because some of that amortization, the old amortization stuff, becomes a little challenging to make sure we get it allocated to the right people, because we may or may not know exactly what division everybody came from and some of those things. So it's much easier to just figure the cost of the benefits that are being earned going forward. We can nail that very easily to who's doing it. It gets a little trickier with that old amortization piece. So. I'm not going to go into all the details here of what these new GASB disclosures are, but essentially over the last 2 years, GASB, which is the Governmental Accounting Standards Board, so it's who regulates not just the pension disclosures for you guys, but all of your financial statements. They made changes to the way pension plans have to be reported upon, and honestly, it shifted it away from the way it used to be to a little bit more like a private sector company has to report things. The biggest change being two things. One, it changed the way the plan has to expense it. So what expense now hits the town's income statement is calculated entirely differently, and we'll hit that here in a second. The other change it did was the impact it has on your balance sheet. It used to be sort of a convoluted calculation between what you should have contributed and maybe what you did contribute. Now it really boils down to, and I'll oversimplify it, but it really boils down to say, what's your liability, how much do you have in assets, and the difference in those is what goes to your balance sheet. So it's fairly straightforward now, but it for you guys, it actually amounted to about $110 million hit to the balance sheet in 1 year because of that change. So it was a big change. Now, I say it was a hit. Any of the rating agencies and all that stuff, they knew it was there before. Right. This wasn't like it was news that came out of nowhere to anybody. They knew it was there. It's just explicitly there now, not implicitly. Okay. So, page 17 just shows the way we get to this expense number. There's lots of little pieces there, but essentially it's this. That service cost, it's the accountant's word for the normal cost we talked about earlier. So it's the cost of the benefits being earned. You would think we could use one term for that, but everybody gets their own rules. So we got to use the service cost for them. And then interest on the total pension liability, that second one is just, it's sort of like, think of it like your mortgage. You've got that unfunded liability sitting out there, and we're saying by not paying anything on it for a year, what's the interest that's accruing on that unfunded liability? And that's the charge. That's obviously by far the biggest charge that hits to you guys. So the other things are, what do we expect assets to earn? What are contributions that are going in? other little things that impact it. But the biggest thing is, what are the cost of benefits being earned and that interest then on your unfunded liability? And all this is a completely new way of calculating this expense compared to what it used to be. Page 18 then gets into the balance sheet side of things, and you can see the way this works now. Like I said, it's fairly straightforward in that the white bar is your total pension liability. The black bar, they call it the plan fiduciary net position. Think of as just what's the assets that we've got there.
Okay.
And take the difference in those, and that comes up with your net pension liability. So that's how short you are. Now, if we ever got to an overfunded position, you'd have an asset on your balance sheet. But that's the way the calculation works. Just some comments then about the projections we've got. So if we flip to page 20, we put 3 projections together for you with varying asset returns. These are, long-term projections, 30-year projections, and we assumed assets return 6.5, 7.5, or 8.5. We don't know what it's going to be. Who knows? If we knew that, we'd all be rich. But bottom line is, when I look at this, what I see is this. For the next 10 years, it honestly doesn't really matter what assets do from a return standpoint for you guys. And if we go back and think about where your plan's at, it sort of makes sense, right? I mean, we've got $30 million, which is not a small amount, but we've got $150 million in liability. So comparatively speaking, our asset value is pretty small right now compared to what our overall plan is. So asset return just isn't going to drive all that much in the near-term future, near-term being the next 10 years or so. The good news for that is that when we have years like the -1.4 or whatever like we had last year, and honestly, from July 1/15 to the current point, hasn't been a real great asset year for anybody either. Those aren't good. We'd rather have the opposite, but it hurts you guys a whole lot less than some other plans right now, which is good because it can keep you going on this stream of saying, okay, we pretty well know what our contributions are going to need to be for the next 5, 10 years maybe. We can plan on it and get it in there and start building that fund balance up, and then we start caring about asset performance more. So, but as you can see, I mean, it really, the numbers are going to increase here from about 57% of payroll where we're at now to it could get up to 70, 75%, depending on which one of those paths we go. So we're at a big spot now. It's going to get bigger as time goes from a percentage of pay contribution standpoint. Once we get that unfunded liability paid off, then you can see it really drops off and falls off a cliff. And the reality is probably 15 or 20 years from now, we can work on making it not such a big, hard cliff with you guys.
That
Smooth it out a little bit and make it less of a cliff.
Do you have like a roundabout number as to where that percentage of payroll is when you should do that, when it's getting to that 75%? I mean, do you have like a number?
Yeah, I don't know that I would say that there's a number that's based on a percentage of payroll as much as it is a couple things.
Yep.
One, historically, plans have gotten themselves into trouble by re-amortizing all the time.
Yeah.
Because you never get anything paid off then, right? So what we would want to do is say, hey, we've got to see some pretty significant growth and impact on this thing before we want to re-amortize stuff. It'd be a conversation, though, ongoing we'd have with you guys, with the town, to say what's going to make sense, because I don't know that it makes sense either to run this all the way to 75 and then drop it down to 6 or whatever after that in 1 year.
Yeah.
That doesn't make sense from a town functioning standpoint either. But just where things are at, we'd want that to run 15 years probably before we really even start doing that. So. After that, we just get into the appendix where there's a lot of details about what the benefit structure is, some of the assumptions that we've used on a lot of things. I'm happy to answer any questions on that, but I don't know that it's worth you guys' time to dig into it here at this point. So, any questions or anything? No, we went through it pretty quick, but I don't want everybody to fall asleep on us either, so.
Does anybody have any questions on the board? I mean, I kind of, when I thought of them, I asked, but I don't know if anyone else had thought of anything or made any marks. Any questions from the public?
Kevin O'Connell, I'm the chairperson of the West Warwick Police and Fire Disability Association. I just have a few questions. You said the 1.7 million that were deficient has to be made up over 5 years?
It's, so the number we're talking about here, when the assets didn't perform as well this year as they would.
Correct. It was at 4.7, I think you said?
Yeah, it was
Wait,
1.7 million, right. It wouldn't have to necessarily be made up over 5 years. It's going to be, what we're going to do is when we do our calculations, we're going to look at it and say, hey, you know what, the assets didn't come in where we thought they should, so it's going to get built into the next, actually it's going to be closer to like 18 or 19 years now, and will be spread over that period of time to be paid off.
And that would be included in your required contribution?
Yes, absolutely.
So this year would be 8.7 million, so it could actually be 8.9 million, your recommended contribution?
No, that already builds that into it.
For this year?
For this year. So we'll get to next year and see what happens over the, over that next calendar year, and each one keeps building layers into it to add on.
And if I'm correct, if they decide not to do anything with that 1.7, the town, if they say, look, we don't want to deal with that right now, that 1.7 million will grow rapidly if they don't do anything with it, correct?
It would, but to be honest with you, the way that calculation gets done for us, it's just part of our contribution. When we come to them and say, hey, the recommended contribution for what would be next would be the 17-18 fiscal year, that's just going to be part of it. It isn't an optional piece of it, I guess. So there isn't something where they could explicitly look at and say, well, we know $200,000 of this contribution is due to our asset performance, say.
Right, so
It's
it's
in
not
there.
separated from
Yeah,
the
we
ARC.
don't separate it out. It
So when
is-
the market-
So it's part of the 5-year
When
plan.
the-
They're going to be required
When
to
that
do
market
that.
underperforms, it needs to be made up by the town. When the market overperforms, the town makes out. You know,
Okay.
Yeah.
It's just smooth, so it's not, this year, our ARC's 10 million, but next year the market did awesome, so now our ARC's 6 million. It's not to jump like that.
Okay, let's get back to the market now. We've had this conversation at a financial town meeting once, and you know me about administrative costs. Okay, I was told before this pension board, there was other pension boards that administrative costs were paid by the town. And then somebody came up with a figure during the town meeting saying, Kevin, we can do administrative costs through the pension if we make the earmark of 7 point some return. We can take it out of the pension. Well, it doesn't look like you did it this year. You did 4.7. So how are we taking the administrative costs out of the pension fund if you didn't meet your earmark, which was set at the town financial town meeting 2 years ago, that Nick Denise said it had to be like, if you do 7%, you can take the administrative costs out of the pension fund.
I can't speak for what Nick Denise said a couple years ago. I really don't know, but
Well,
as far as I know,
think we were part of the conversation, you and I, back then. Remember, I had a
Sure.
problem with that?
Yeah, so earlier I mentioned that 7.5% return assumption that we have, that we work with the investment advisors on and everything else. Ultimately, that 7.5% return says, we expect you over the long term, not any 1 year necessarily, we know it's all going to fluctuate up and down, but over the long haul, you'll earn 7.5% on your assets after the expenses have been paid, be it investment, administration expenses, whatever it is, whatever those expenses are paid out of the trust, you'll earn 7.5% after those expenses are paid. And if it comes up short, what ends up happening is just like the first question you asked, it
It'll
makes
increase
that
the ARC.
expected contribution higher. So it ends up getting paid then that way.
Okay.
Yeah.
So if their administrative costs go, so my next question is, wouldn't it be plausible, like I know every department in the town runs on a budget. If the pension board had a budget to run on, and they ran out of money, okay, paying, I don't want to say frivolous accounts, okay, but I think you get my drift. we never had attorney fees again, and that takes up a lot of our expenses. Clerk, we never paid those before. And I was just going through my files the other day, and I found a tape that truly said that administrative costs are paid by the town of West Warwick. It was on, from Vinnie Marzullo, Steve Alves. I got the tape at home. Okay, so administrative costs were never paid. A lawyer was never paid out of this pension fund. It was borne by the town of West Warwick. We used the town solicitor. We used the town solicitor as your lawyer. The pension board at that time didn't like what the town's lawyer was telling them. So they wanted their own lawyer. And Vinnie Marzullo says, that's right, I don't like Susan McGurl, I want to get our own attorney. And my buddy, who was the vice chair of the disability group, says, well, who's going to pay for that? And Vinnie Marzullo says, well, we're entitled to our own attorney, the town will pay for it. Okay? But lo and behold, 10, 15 years later, it's coming out of the pension fund. If I respect you need counsel, okay? But I don't think you need it coming out of the pension fund because you don't have a budget to work on. You're working on the assets of a plan, withdrawing it because you have no budget. If you had a budget for an attorney for $30,000 a year and then you ran out of money, you'd have to go to the town council and say, look, we need to have our budget increased. So you wouldn't have a free run. And I'm not saying you people are doing anything wrong. I'm just saying if you have a budget to work on, you can really pick and choose the battles you're going to fight. Because if you're going to hire a lawyer for every decision you make and an opinion, it can, and as you can say, we went from 26%, we're down to 19% now. So I know it's a small asset or a small expenditure from the pension, but it's an expenditure that you have to look at, and that's all I'm asking you to look at. You have to look at it and say, wait, where can we cut to make this pension whole? Okay, we know it's being underfunded. The town is on the right track doing the ARC, but you have to do it. You have a responsibility to say, hey, look, we never did this before. Maybe we can use the town attorney. It'll save us money. I see bills, $10,000, $15,000 a month. Okay? You ask a question, you ask your lawyer. You people are smart enough, you should be able to make a decision on your own.
What was the date of that tape? Do you know the date?
I can let you listen to it. I'll be glad to give it to you.
Okay, no, we should.
You should, absolutely. Nobody wanted to up until this point, but I think you should so you really know what's been going on. Because there's a lot of things you do now that wasn't done before. And people say, well, it's always been that way. Well, just because it's always been that way doesn't make it right. You have a chance to correct it. You're the board right now. You have to look at these things and say, look, you know, maybe some merit in what he says. Maybe he's blowing smoke. But check into it. It was done differently. And I know it was done differently, I'm telling you, because I sat on the board. Okay? So I know it was done differently. So just give it a chance and use your heads, and you probably can save some money if you really, really, really want to try. And that's all I say, because we do have a vested interest. Now, I'm glad to see there's union people on there now. You have a vested interest. We all want to see this thing to prosper. Let's get it done. And I thank you for your time. Thank you for answering my questions.
Thank you.
Thank you.
Any other questions from the public? Seeing none, Clearbrook is the next item. Are they here yet? I think I saw them out. Good evening. Nice to see you, Mr. Ingram. Good to see you. Thank you. Good to see you. Good.
So we just handed the committee the February flash report. What I thought, though, is that we could, because we have some new members, maybe discuss or just mention what we do. We're Clearbrook. My name is John Cheshire. This is Tim Eng, our Chief Investment Officer. And we handle the outsourced CIO function. Basically, we're the investment arm of this fund. And what we do, basically, is we have discretion over the portfolio according to the investment policy that we've all agreed on. And we'll make investments according to that investment policy statement. What we are able to do is get the economies of scale that we have with other clients. Sure. And make things cheaper for you, make decisions on your behalf that are more efficient. Just a point of reference, the average equity mutual fund is 140 basis points. Our fee all in is 122 roughly. That's with the funds, with our expense. So we do make things cheaper for you. I don't know, if you want to talk about markets for a little bit, we could do that.
Yeah,
And then I can talk about the fund's investment performance.
Yeah, you know, and, yes. Yeah, please, any questions? We're open to questions as well. You know, as John mentioned, and I just want to make one clarification very quickly. As John mentioned that typically a fee in a mutual fund for one to buy them in the marketplace, usually about 1.4% or so.
Correct.
So overall, the fees on this account, as we have it based on the discounts we've been able to get from some of the investment managers and whatnot, all in including our fee is 0.92%. I just want to clarify that.
Yeah, I'm sorry about
So it's 0.92, okay? So that's a big difference overall.
Yeah.
So what we do typically for funds like yours is, since we manage overall about $30 billion, as we see the mutual funds, even the Vanguards of the world, the Fidelities, if we can get you a lower fee, we will pass that on to you. Because what we're going to do is negotiate on your behalf. That's our job. So what we're trying to do is get you the best return, the best money managers possible, but always at the cheapest cost, if that's always available to us. So that's what we're trying to do overall.
In funds where you don't meet the minimum, we're able to lump together our other clients with your funds. It's still separate, but for fee purposes, and get the institutional share class, which is typically a lot lower than if you were to go and invest yourself.
Yeah. So just overall, for everyone who's been going through these crazy few months and looking at the markets every day, and you go, what the heck is going on here? So when we came into the new year, everyone was worried about really one thing on a global basis. There was going to be an economic slowdown. Everyone was worried about, first here in the U.S., economic growth has been slow. It's been less than 1%. The fourth quarter came in 0.7. That's very low. Just to give you all a perspective, when the economy has been doing well, that we saw in the 80s and the 90s, economic growth, you would see numbers at 4% plus 5%. All of a sudden, the markets are seeing 2%, less than 2% growth, and everyone was worried about, gee, we're going into recession. Same thing in Europe. Everyone was worried about no inflation, recession. And that compounded itself by seeing what we saw coming out of China in particular. China, why did everybody worry about China? Because China's been growing the fastest out of all of the big countries on the world. It's been driving economic growth in Europe and also in the United States. So everyone was concerned, if the Chinese are slowing down, Europe's slowing down, and the U.S. is slowing down, we're in the crapper. Basically, that's what everyone looked at. So effectively, everyone said, since the world's going into recession, then we should sell basically stocks and bonds. Why? Because they're too pricey in relationship to a huge slowdown in the global economy. So everyone was pricing in a recession on a global basis. So all the markets that you saw in January and February, a lot of them sold down 10%, 15%, and even worse overseas. Lo and behold, you wake up now in the first 2 weeks of March, everyone's saying, you know what? Maybe it's not so bad. You know? Numbers just came out the other day. We're going to have record auto sales in the United States. 17.5 million cars are projected to be sold this year. Housing growth continues to do very, very well. Now, all of a sudden, the first projections for the first quarter of this year in the U.S. is economic growth could be between 2.5% and 3%. Oh, well, it's not below 1%, as everyone was suspected. All of a sudden, now we're getting greater clarity in terms of what the Chinese are going to come in at around about 6.5%. Well, that's not a recession either. That's pretty darn good. So a lot of the worries about global growth basically affected a lot of the markets and whatnot. That's what you saw oversold. So just a reminder, what always happens in the world of finance is emotion takes over. And when emotion takes over, what you don't want to do is make irrational decisions. And that's really always the key to investing. If you truly believe that what you own is going to be good in 6 months to a year, don't worry about what's going on in the first month or few weeks. That's really the key, and that's what we did. So effectively, and John will go through the portfolio, is that we stuck to our guns. We said, we believe that stocks in certain areas of the world are cheap. Certain other assets are cheap. We're going to hold it even though we're down. And then, you know what? Lo and behold, it has come back very, very nicely over the past couple of weeks. And John can basically go through what's happened during the first at least 2-3 months of the year so far.
Yeah, thanks, Tim. So the report that you have in front of you is the February report. It's what we call a flash report. It's just a quick summary of what happened with markets and with your portfolio. On a year-to-date basis, the portfolio is down 3.9%. However, as of Friday, the portfolio is only down 1.6%. So it has come back, just to Tim's point about the markets being volatile. So 51.9%, 8%, was in equities within this portfolio. 31%, a little bit more than half of the equity exposure, was in domestic equities. And then international equities was about 20.8%. So you'll see a mix of active managers, stock pickers is another term, and index funds in the equity exposure. What we do is we will use active managers, stock pickers, in areas where we see opportunity. But we mentioned earlier about trying to keep costs low. We'll balance them with index funds, because that brings the expense ratio down significantly and still gives you that equity exposure. In this instance, for the first couple of months, the active manager, Dodge & Cox, was down 7.5%. Now, they have a fair amount of exposure to financials, and we expect that to be an opportunistic area for the next 12 to 24 months. So we're standing pat with those guys. We're not expecting any changes there. Silvercrest is a small cap value manager, down 5.9%, but a little bit better than the Russell 2000 value. We met with them last week, and they've actually seen a fair amount of opportunity in the market, and they're actually kind of excited about it. They're starting to take a little bit more risk than what they had taken in the last 6 to 9 months. DFA is another small cap manager. They're more active, larger portfolio. They try and add value by lowering trading costs. Trading small cap stocks tends to be a little bit more expensive than managers who trade Apple or Microsoft or GE. Within the international equity exposure, that was down 7.9%, in line with the index. There's a fair amount of index exposure there with the Vanguard Developed Markets Fund. The active manager that we're using a manager Causeway. We use them for their large cap international stocks and emerging markets. Emerging markets have had a tough time, and we expect them to, opportunities over the long term. Certainly an area where you need active managers. Still may be a rough go of it, but we still think that there should be exposure there.
One of the things that you're going to hear a lot of the investment managers around the globe, whether you're in Vanguard, Fidelity, or whatnot, a lot of people lost money in the first couple of months being invested in bank stocks. Okay, everyone was worried about banks because as interest rates come down, what ends up happening? Banks make less money. Okay, and you have certain areas of the world, 60% today, if you can believe this, of the developed markets in the world have negative interest rates. What does that mean? You put money in a bank at negative interest rates, meaning you pay the bank for them to keep your money. Crazy concept, okay? And what they're trying to do is saying to the banks, don't leave the money sitting there, lend it to businesses, lend it to consumers, let them buy things, let them get businesses going. And that's effectively what's going on. But now the banks basically are effectively, as interest rates, particularly here in the U.S., are going to start going up. Everyone's been wrong for 2 years, flat out wrong. Okay? But eventually rates are going to go up, and we're starting to see that now. That's when the banks are going to begin starting making money. And all I know is every time I go in an ATM, they're charging me money to take money out of it. So they're finding ways to make a bit more money. So that you're going to see come back at this point.
Moving to the next page, the fixed income exposure. We have a position in Baird, 5.6% of the portfolio, up modestly, 40 basis points. Really where the bang for the buck, though, in the fixed income exposure is going to be with Double Line. That fund is run by a very experienced team that takes it's a core bond, meaning that they're going to invest wherever they see opportunity in fixed income markets. It could be government bonds. It could be what's called asset-backed securities. It could be corporate bonds. Wherever they see value, that's where they're going to go to.
But the one thing then on your fixed income side, this is what's very important. Okay. For all of you who own bonds, okay, in your 401ks, your retirement funds and whatnot, when you own a bond, as interest rates go up, bond prices go down. Okay. What's very, very important is what they have is called an average duration. It's the number of years of risk that you have in your portfolio. As interest rates go up, the lower that number, the less affected you are as interest rates go up. So typically a bond portfolio has about 6 to 7 years of risk, quote unquote, within a portfolio. We believe that interest rates are going to go up. Our average length of risk in your portfolio is only 4 years. So it's less than almost half of what a normal bond portfolio you would see in terms of overall risk. And that's how we position the portfolio, to protect basically the principal of the portfolio as interest rates go up.
And that's because of the Baird position. Double Line also has a shorter exposure, and then the intermediate term bond index helps shorten that up, shorten as a finance term. And then we sold the Wells Fargo fund. We talked about that last meeting, and that was largely because the performance wasn't that good, and they had a very large exposure to emerging markets, which we, as markets started to trail off, we weren't necessarily comfortable with. So we decided that portion of capital, that portion of funds would be better. You'd get a better return elsewhere. So that's what we did. Also, the last meeting, we talked about our position in hedge funds. We have, I guess, gone back and forth, gotten paperwork squared away, and transitioned the portion of the portfolio, it's roughly 20%, into hedge funds. These funds are not meant, as we've discussed before, to increase returns significantly. They're more meant to be a risk reducer in this portfolio. So you're not going to see these managers in the news about positions in stocks that have gone bankrupt. They're very well diversified funds, and not intent they're more intended to reduce risk in the overall portfolio. You'll see, though, because this was as of the end of February, they're still in transition, so there's a little bit of cash that still needs to be invested in those funds. It just happened because of the date of the end of the month.
But for those of the committee, just to remind everyone and members of the audience, hedge funds for a lot of people are always this vehicle that tends to not be well understood. Okay? And a good example is what's just happened in the first 2 months. The stock market, if you look on this report, was basically down 6.7% for the first 2 months of this year. The hedge fund portion of this portfolio was down only 2.7%. So you did 4% better than the stock market because they're able to hedge downside risk. And that, to us, with all fees in, is exactly what they're supposed to be doing in the portfolio. If the markets get better, they'll make good return. But when the markets are bad, as they have been over the past several months, they protect your downside risk, and that's why they're there in the portfolio. So that's what pays for themselves from a fee perspective. And that's the reason we have them there. If the markets were to turn, and all of a sudden, everything's great, we get GDP growth at 5%, the markets are up 20% a year. We would be the first ones to come in here and tell you, we're going to take out all of the hedge funds, we're just going to buy the S&P 500, and basically it'll cost you 5 basis points. That's our job to do that, but what we're trying to do is always give you the best return for the least amount of risk
And cost.
and cost in the
Just
portfolio.
just a question on that. The alternatives, it's saying, minus 2.7%. Is that including the fees? or
Yes,
is that,
it's
so that's
always on an
after
after-fee
fees?
basis.
Yeah.
Absolutely, absolutely.
Okay.
Any other questions? Questions? Yeah.
Yes.
You, Albert Hero, retired from the fire department. You made a statement that decisions should not be made by emotions and wait out a time period and see, because the fluctuation can happen and you need to see what the long term is. Who makes that decision that when it's time to change the investment, or can this board ask you to reinvest something in a different market or something such that if it's starting to lose a lot and they want to make a change so that's turned into something different, who makes that decision?
So there's a couple of different answers for that. There's what I mentioned earlier, an investment policy statement, and that is formed by the committee and us, and it basically gives you some ranges in which you can invest. So you could never be 100% in alternative or 100% in one particular stock. There's rules, and that takes some of the emotion out of it. But at the end of the day, the committee, this fund, we have discretion over the vehicles that can be we can invest in based on those guidelines.
Okay.
And then we have a 6-member investment committee that we meet with every week, and we talk about those investments and what opportunities we're seeing. We also have several analysts that are looking at opportunities, and then we formulate ideas or look into certain ideas and make investment decisions based on that committee decision. It's not one person, and there's not emotion in the decision.
But all the decisions, the guidelines of what we can and cannot do have been approved by the committee. We work with the committee every quarter, as we do
Okay.
now.
That was my other
And we
question.
go through all of the changes that we make, as we do here. And we even have in-between meetings, off quarter, if we need to, if there's something that's important that's happened, we inform the committee what our thought process is, what we're thinking, and then basically keep everyone well informed as to what we're doing, to make sure.
Okay, so it's like a quarterly meeting then?
Yes, absolutely.
And also they get these reports monthly,
Monthly?
so they're aware of, everybody, so everybody can be aware of what's going on in the portfolio.
We have access to those when they come in monthly?
I haven't gotten those monthly, to be honest with you. I just seen them.
Okay?
I have
Yours is
no-
up first, so.
Yeah, the reason is
We're
because
going
we only got vested just as of January.
I assumed it was.
Yeah,
Oh,
just
okay.
got into it,
exactly.
but
So now
I
this
see
is the first monthly,
The first one.
and then you'll effectively get now monthlies,
after this.
and you'll get a lot more paper on a quarterly basis as well. And you'll have those available to you.
Thank you.
You're welcome. Okay. Any other questions?
Just for international, how is that bouncing back? Because that was a pretty big drop there, almost minus 8%. We got
Yep.
21% basically into international markets. Are they bouncing back as well in the
Yes.
first couple weeks of?
Yeah, they're bouncing back
March.
actually faster than the U.S. markets.
Good.
It's because what ended up happening was, we believe that two things were going to happen in Europe better than the U.S. One, economic growth on a year-over-year basis was going to be faster in Europe than here in the U.S., number one, based on currencies. Their currency, the euro, had come down a lot, okay, over the past year and a half, 2 years, versus the U.S. dollar. When that happens, European companies have an advantage. They can export cheaper, and basically that helps their economy a great deal. And two is, on a valuation basis, stocks are always looked at, they call it the price-earnings ratio, right? It's price over the earnings. The lower that number, the better it is from a valuation, but it's cheaper. So if you looked at the end of last year, the U.S. was trading at about a 16 times earnings ratio. Europe was more 13, 12 times. So it was cheaper, better economic growth, and that's the reason why we shifted to Europe.
So, just to answer your question about the particular funds, I don't have the actual return for your portfolio based on the weight, but Causeway International was, as of Friday, down 5.93. The emerging markets, which was down 7.8%, is now down only 1.67%.
That's a big move.
Yeah,
Just
in a
couple
week,
weeks.
yeah.
Yeah.
This is as of the end of February, so.
Yeah, that's a big move.
And then the index fund was down 3.89%.
All right. I guess that's it for your presentation. Any other questions from the public?
Okay.
Thank you, gentlemen.
Thank you.
Thank
Thank you so
you.
much.
All right. Items L, M, and N, we want to save those for executive, Krista? Okay. The legal opinion letter.
That's a letter that we've had going around for a couple months now. We changed it to a pension board opinion request form, and what it is just a formalization of the process for how anybody can ask a question that they would want a formal opinion from the pension board. One of the things that we had discussed was having a formal process in place for how this form gets used. So, for example, if there's a certain number of hours of research that you would want the board to be able to do, or certain questions that you would want to be asked quickly versus not quickly, or how you wanted this to be formalized, if it was just something for the public or for everyone or for just the board members. So the form, I think, everyone's kind of had a chance to look at, so I don't know that if there's any changes, we can make them, but it was more a question of the process that everybody was waiting to decide.
Right, that got circulated between different groups, correct?
Yeah.
Yes.
Yep.
All right. Did we approve that last month, the way it looked?
The-
As far as,
We discussed the way it looked, and everyone, I think, was pretty consistent with agreeing with the way it looked, and then it was just the process that it had gotten tabled.
okay. I mean, I don't think I have any changes for that form. It's
Yeah. No,
been
the last
pretty much-
revision we did was January 11th.
That was the last time, and I think that was fine. I think everyone was, I wanted to say we waited for a full board, maybe.
Because Nick was absent.
I think that's what it was. But everybody was,
Table it and then decide on the process.
yeah.
And then we're
That's
gonna
how
put
it
it on one page.
And it's on one page, it should be on one page.
And that's right.
Yeah.
Oh, that's right, yeah.
It was on one
Yeah.
page.
Yeah, one page.
I'd like to make a motion to approve that letter and its substance to use.
I second the motion to approve the legal opinion letter.
Motion's made and seconded. Any discussion? Seeing none, all in favor?
Aye.
Opposed? So voted. And the letter work chart for income verification. Anything for open, or we want to save it?
This is something that's been passed around too, I know, to the public as well, as far as trying to make what's a very confusing sections in the plan a little more readable. We tried to make examples so that people could fill in their individual information depending on what section of the plan they fell into.
Right.
And there are a couple of different sample charts that we went through to see what was easier as far as how the examples worked. Was it easier if we did a formula, if A is greater than B, then go here, or if A plus B plus C equals whatever, the number you're trying to get for the formula, or if it's easier for us to just use a person example, so John is a normal retiree and he's making X, Y, and Z, and kind of let people understand it the more that way. So really what we had done is taken the three different possible applicable sections, 4.05 and 4.08 for police and fire, and then 4.05 for the plan excluding police and fire, and made a couple of different examples to try and see how basically user-friendly we could make it. Each one has a different little bit of a format. Some have the formula, and some have kind of the more of step-by-step word problem type instruction. So I think the point we were at was just seeing what everybody thought was a little bit more user-friendly, or if we wanted to include an example of each kind of calculation so that people could fill in the blanks, however it made it easiest for them to calculate what effect that any of these offsets might have for them.
Is Kevin still here, or is he? Yeah, Kevin. Just as far as the work chart for income verification, did you get a chance to look at any of that? Or is that emailed to you?
I did.
Okay. Any thoughts that you want to share with that? As far as how it's laid out, what's going to be easiest for you? Sure.
As you know, we had that meeting with Fred Presley and the town council members, and yes, I don't know if you were there, Dave.
No. it was
I know
a
Nick
few
Denise
months
was.
ago.
They suggested that we have a big meeting so all the guys could attend from both organizations, probably at the high school, and discuss what the proposal is, and, because like I said, I'm the head of the organization, but I don't speak for all the guys, and they have questions, and I know Krista, and I gave this to Nick Denise, and I think all of you read it now. And I have a lot of questions on this that need to be answered. Matter of fact, every page needs to be answered. What your view is on it, opposed to your other counterpart, Mr. Pezza, who was the pension board's attorney back in 2003, who you paid a lot of money for this, and it seems like the pension board went along with Mr. Pezza's recommendation up until 2013, 14. So it's at least 10 years that the town went with Mr. Pezza's recommendation. Your counterparts before you, and they had no problem with it. So it just seems recently, since there's a new attorney involved, that I think Mr. Denise called Mr. Pezza not a very good lawyer. I think those was his words to the town council. But he was your lawyer. You hired him. I didn't. Okay, so he made a recommendation to you people. All the questions were asked about income verification, about being recertified. Mr. Pezza did an extraordinary job in researching this. I've read it. I think you've all read it now. I have to have these answered before I can bring it back to my body and tell them why your attorney disagrees with Mr. Pezza and what grounds that, before I can even discuss that chart. It's a very good chart. I mean, I can understand it, but I need this answered before I can go back to my membership and give them a recommendation. So there will be no name calling, and I can say, hey, this is what they're saying. They're opposing what Mr. Pezza said, that when you guys were out, this was the law of the land to the pension board. Now it's changed, and if Krista leaves someday, there'll probably be a new opinion coming out. Okay, and that's what happens with a pension board. You get new attorneys, new opinions, and but I need this answered before, because most of my guys went out under this recommendation from Mr. Pezza, and I'd like to just see what your and Krista's opinion is on Mr. Pezza's determination. So that's it. I mean, I've read it, but I can't recommend it because I don't think you have the authority to do it. But that remains to be seen. So, any other questions?
No, I just wanted to make sure that it did get circulated.
Oh, yeah, I did get it. Yeah, I finally got it. I read it, and
Any feedback,
I just can't give you any feedback because I don't have the answer to these yet.
I got you.
Okay, so, thank you very much.
Thank you.
Thanks.
Any action that we need to take on that?
No.
No. Next item would be new chair and vice chair. I think we can save that for executive, just to talk amongst ourselves first. And we have some discussion items here. We have Nick Denise's resignation letter. Is that included in the packet?
Yes, all of that is included in the packet.
I'm not going to read this
Except for,
entire letter, but
maybe I did do the OPEB. I think I just wrote on it.
so as most of you may have heard, Nick Denise did put his resignation in this past month. We want to thank him for his service. I think he was on the board for like 5 years or so. He did serve as the chair for a while, so we just want to thank him on that. Going forward, I mean, it's going to be up to the town to get another member on this board, but we'll see what happens with that. The Pier Capital Confirmation on Funds.
Just stick that in there.
Yeah.
And just put it
Yeah,
on
just
there
throw it in.
for FYI.
They're closed out now, as far as I'm
No,
aware.
it's
Yeah,
just your
so
last
that's just the last
confirmation.
statement on
It's
that.
just an FYI.
All right. The Clearbrook invoice first quarter.
That I put on there as an FYI.
Yeah.
Because now they just take the money, so no one gets to see the invoices.
Right,
You
it's
guys-
not like a bill that we
Right, so I
pay.
just put it on for everybody's
Just to see it.
knowledge. Yep.
Okay. Oh, yeah, and the OPEB, I did get your email on that.
Yeah,
So that's
so we took care of that
being taken,
$1,000.
very good, all
Yep.
right. Public records request, I remember seeing the email on that for the,
Yeah, there's a public record in there.
I don't know if it's in
It
here.
should be, right?
Yeah.
I thought I did,
Toward the end.
and I just put it in there because you guys can decide what to do with it. I mean.
Do we know who that is? I don't,
So I just.
We're in
wrote
New York,
it.
right?
I remember seeing an address out of New York on it, but I just didn't
I
know.
have no idea.
He's asking for the Nyhart report or the,
Oh, for the,
It should be at the end unless you missed it.
oh, didn't I get Nyhart? Hold on.
It's right
Oh,
there.
was it the Nyhart report or was it Clearbrook? They
Right
wanted
there.
to see.
Best
The public record, yeah, Councilman
Why do I not
Simone,
have it?
he wants the investment report of the town pension fund for 12/31. That would be Clearbrook, right? Yeah, that would be Clearbrook.
It almost
I
sounds
didn't
like he
do-
wants to know the
Yeah,
allocation.
I didn't do anything with it, I just forwarded it to you guys.
All right. I mean, I wouldn't have a
Guys, let me
problem.
know.
That's that's
We can just send
public
them what
knowledge.
Yeah.
Just send him whatever he needs.
I'll let you know, I'll do it tomorrow.
Should we have a motion on that, or is that not needed to release something like that?
It's public record.
Okay.
Those are already on the website, aren't they?
I don't know if they're on the website.
website, I'm not even sure, but I'll answer him
They might be on
tomorrow, and I'll do
OpenGov.
it.
They might be on OpenGov. I'm not sure.
I don't even know how to get on OpenGov.
Yeah.
Show you.
Gave me
Yeah,
anything.
you know how to do that?
Yeah, you work with that, so I can help you.
Oh, I can
Good.
get on there, but I don't know anything, no one even told me it's up and running.
Yeah.
That's the knowledge, yeah.
That's nice.
The bids received for RFPs.
I gave them all their bids the last time, I gave you your copies.
Yeah.
I just didn't know if you guys wanted me to put it on the next agenda, so I figured you can let me know what you wanna do with
I
that.
think so,
That's why I
yeah.
put it on there.
Yeah, we'll just have it on the next agenda if we can table that.
Next agenda, I figured I'd give you guys time to look at it. And the last thing was the answer on that pension and investments, I did call, when I called the other day, I think I just wrote a note on it. It was like $187.50 if I would've canceled that day, so if you guys want me
Yeah, you
to
were in that
cancel,
meeting.
yeah, I
requested
can't,
you
it
to
was,
cancel it.
Yeah. I'm not reading it. I mean,
well, here's another one, but
Yeah,
I can cancel it, but you just have to give me
I want, as long as we
permission to
get
be
money
able
back, I
to
think we
do
should
it.
cancel.
yeah, I
Did
agree.
you want to read at least one? No?
Yeah.
Jeff,
Is
I
any
I have some,
Yeah,
I have some,
I don't
Jeff
know.
has some.
I don't really like that to begin with. Do we want to make a motion on that to cancel?
I don't know if can they do that in the discussion? I guess I'd have to wait till
All
the
right.
next agenda.
Put it on the
They
next
just asked me
agenda.
to check into it, so I did, so I just put it on.
Yeah, no problem.
But we still cancel it, get $100-something. but
Yeah.
I'll put that on next
I
agenda.
don't know what kind of value I'll get out of that.
The benefit estimate statements while you're here, you guys are gonna have to decide. I brought this email, I know I emailed all of you on this, one of the last ones, about the information, about the outstanding things. They still need to decide about how to service. That's the last piece, so I'm gonna let the board decide before we can move on with the benefit estimate. So I brought this email, I did forward it to you guys. You guys might wanna think about putting this on the next agenda to go on it. It's still those estimate statements. They still have some things, there's remaining questions below, but I think that's something you guys might have to decide. I can't do any more on it.
Okay.
Okay.
So maybe I'll put it on next
Yeah, put it on.
Yes.
And, I got the answer on the ACH, the mailing the stubs, there is no charge. But there's a charge for each monthly distribution that, each pension retiree statement that goes, but not the mailing out.
But the ones that want it, yeah.
That's what they told me, and I got it in writing that there is no charge to mail it out. So I would need a list, because Rockland's not mailing out the actual ACH stubs for the direct deposit.
Yep.
I think they did the first time, so a bunch of people have been calling, so I told them if they want, they could just give you their name, and they said they'll send it to the people that want it, but I wanted to find out if there was a charge, and there isn't.
Okay.
Let me know. Well, I'll write it down.
Atta girl.
All right,
This
any other discussion from the board?
next agenda.
No.
Nope.
Seeing none, any comment from the public?
Kevin.
Evening, everyone.
Good evening, Mr. Villa.
Good evening. Good evening.
Paul, I just have a question on one of the discussion items you had here on Clearbrook
Yes, sir.
invoices. I know Tracy said they're taking them out quarterly. Are those charges, are they the same every month, and are they published somewhere of how much they're charging us?
No, that's,
I noticed you broke the lawyers down,
Yeah,
in
no,
this,
that-
in this agenda.
And it's not the same every
No,
month.
they
It's
do
based on,
vary.
asset value, isn't it?
Correct.
Percentage of the
Well, that's
asset
what I mean, so there should be a change every month, if it's that 0.92% he was talking about, but is it published anywhere on an agenda that we paid that monthly?
No, this is the first time we've dealt with this bill.
And that's why I threw it on for an FYI, because they weren't even gonna send us the invoices. And then I asked for the invoices, because I figured I should at least put it somewhere on the agenda. So honestly, I don't know if I did the right thing either, so I put it under discussion just so they could
Oh,
see it
yeah,
and
well,
vote on it, because it.
It was a good idea, but as a suggestion, I would
Yeah.
put that on the agenda monthly so that we can see
Yeah.
how much they actually are charging, if it's in line with that
Sure.
supposed 0.92% that they're
Right.
saying they're charging us for our assets.
Yep, that's a good
Thank
point.
you.
So we would
Thank
have
you.
to
We'll have to
get
get
them to
invoice.
send us something monthly?
Um,
Let us know, or is it
It's a quarterly statement,
I
so
think it's quarterly.
I think just as it comes in, we'll just put it on,
Just put it on,
just for discussion. We'll
Discussion?
put the amount so they can see the amount.
oh, okay, I
You
didn't
know,
put the amount.
No, so the amount for the quarter was
All right.
19,624.33
All right, so next time I'll put the amount. I didn't even know.
Yeah,
Sorry.
we'll just throw it on there. Any other comments? Seeing none, I'd like to move into executive session in accordance with Rhode Island General Law 42-464 and 42-465A2.
All right, wait a second, no, David. I think I have to do that.
I guess I don't need the, well, yeah, I do need this on.
Yeah, take one video.
Pension Board reconvening into open session. I'd like to make a motion to reconvene and seal the minutes of executive session and reaffirm the votes taken in executive session.
I second that motion.
Motion's made and seconded. All in favor?
Aye.
All right, we'll move on to Peter Martin.
And Paul Santamon and Gino, do you want to table those? Agenda, L and M?
Yeah, I'll make a motion to table items L and M to next month's meeting.
I second that motion.
Motion's made and seconded. All in favor?
Aye.
Okay, Peter Martin. We did research, right? We have some numbers.
I put something in there.
Yeah, I've got,
Yep, that's it, that's all you can find.
all you have.
I like the minutes, everything, that's payroll records you could find. That it would be the pension contributions, the deduction.
I wish he was still here so I can ask him, but, I mean, what am I,
You can call him. He said,
Yeah.
he left his cell phone and he said to call him.
all right. So we're looking at payroll history between 2000 and 2015.
Right, he had said he had, you might want to call him, but he did say he had a leave of absence, that he was out for a little bit. And I think he was here in, might have started in like 99, but we don't have any payroll records back, so that's
Prior to
about
that.
all I can find on him.
All right.
He was looking to get his contributions back.
We have no record of him receiving any contributions?
No, I went through the minutes, Citizens Bank couldn't go that far back. We went down here in the clerk's office, that's all I could find on him at all. I tried pulling up to see if he was on any, like, agendas, if his name came up, I couldn't find it on clerk days.
Yep.
Because we did get it back.
How far did those go back?
Then oh God, like the 80s, like
Yeah,
it goes back
okay.
pretty far. But he was here in like 1998 or 1999. But that's the only payroll records we could find.
And do we know when he terminated?
I honestly don't remember.
I don't know how long.
I didn't write it down.
I'm just wondering.
I thought he'd be here.
Yeah.
Maybe 2002, he said?
Yeah.
Around 2002.
I mean, and I just don't know how you guys feel about making a phone call to him while we're trying to discuss it in an open session. It's kind of, I don't know.
Well, I mean, if we need to get the answers,
Maybe list the questions and email him the questions.
Yeah,
call him with
I
the
think maybe
questions.
we should table it, come up with some questions that we need, you know, shoot him some of the figures that we do have and see if he agrees or disagrees with the numbers we have, and just meet again next month.
And I'll definitely, I'll look
So we
up
get
the
his
state
email
determination and all that
address
stuff.
we need.
Yeah, all right,
So we'll just tell him he's stable.
yeah.
I'll give you his number, if
Oh,
if you
okay.
don't mind giving him a call.
No, I'll do that tomorrow.
Okay.
That's fine.
I'll make a motion to table item N.
I second that motion.
Motion's made, seconded, all in favor?
Aye.
Aye.
Item Q, new chair and vice chair. I would like to nominate Lou Bastano as the new chair for the pension board. We need a motion for that? I'll make a motion to nominate Lou Bastano for chair of the pension board.
I'll second that motion.
Motion's made and seconded, all in favor?
Aye.
Aye.
4-0.
Boy, so I can't
Congratulations,
vote for
Chair.
myself.
And for vice chair.
I would like to make a nomination to appoint David vice chair.
I second that motion.
Motion's made and seconded, all in favor?
Aye.
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 Congratulations.
Thank you,
Congratulations to both of you.
thank you.
You
You'll be on
Thank you for-
Tracy's speed dial list now.
Remember, I don't answer my cell phone.
Motion to adjourn,
Seconded.
all in favor?
Aye.
What time is it? Oh my God, 10:17.
10:17? Oh, that's past my bedtime. Time you have to get to tomorrow.
Not good.
6.